All right, let's dive right in. Today, we're decoding the VIX. Now, you probably hear it thrown around all the time whenever the financial news starts getting loud, but today we're cutting right through all that noise to examine the actual underlying mechanics of market sentiment. This is literally the ultimate tool for quantifying uncertainty in the stock market, and we're going to break down exactly how it works and, more importantly, how you can use it to your advantage.
So think about it. Can you actually measure fear in the stock market? I mean, human emotion, collective panic, the sheer anxiety of millions of traders. It honestly feels impossible to boil all of that down into a single objective number, right? We constantly hear about markets being driven by fear and greed, but fear feels, well, abstract. It feels like an emotion, not a metric. And yet, Wall Street actually has a mathematical formula for anxiety.
Officially, it's called the CBO Volatility Index, though pretty much everyone just calls it the market's fear gauge. And here's the crazy part. It doesn't figure this out by running polls or scanning news headlines for negative words. Nope. It does it purely through hard, cold data, specifically by looking at option prices for the S&P 500 index. Basically, the VIX calculates exactly how much uncertainty investors are currently pricing into the market for the next 30 days.
So let's talk about decoding the VIX scale.
Because market volatility is really a sliding scale. It's not just a simple on-off switch. Let's look at the actual numbers. When the VIX is sitting below 15, we're in a calm market, low expected volatility. Everything's pretty chill. That 15 to 20 range, that's basically your baseline, just normal, moderate uncertainty. But the moment we cross into the 20 to 30 territory, elevated stress starts creeping in. Above 30 indicates high fear. And if you ever see a reading shoot above 40, you are staring at absolute crisis-level volatility. We're talking about the kind of financial hurricane we saw during the 2008 financial crisis or the 2020 pandemic, when the VIX famously spiked to over 80.
Now let's get right into the mechanics of fear. We know what the scale looks like, but to actually understand why this number moves up and down, we have to look under the hood. It's not magic. It's literally just supply and demand playing out in 3 distinct steps. First, investors start expecting some big market swings, usually because of some scary news or economic data. Because they expect those wild swings, they rush out to buy options, specifically put options, to protect their portfolios. It's basically like buying insurance against a market drop. And because everyone is suddenly scrambling for this portfolio protection at the exact same time, the laws of supply and demand kick right in, and option prices shoot up. Since the VIX is calculated directly from those S&P 500 option prices, that massive surge in demand mathematically forces the VIX up right along with it. But here is an absolutely crucial point, what the VIX cannot predict. Before we talk strategy, we literally have to bust the single biggest beginner misconception about the fear gauge. There is a massive, vital distinction you have to make between direction and magnitude. The VIX does not predict market direction. No way. A high VIX doesn't guarantee the market is going to crash tomorrow. It simply tells you how large the market expects the swings to be. It measures the turbulence, completely independent of whether the market is heading straight up into the clouds or straight down into the ground.
Which brings us right to the patient investor's opportunity.
Because for those of us playing the long game, the VIX isn't just some abstract thermometer. It's actually a really powerful strategic tool. See, when the VIX is low, investors are super relaxed. Honestly, they're probably a bit complacent. But when the VIX runs high, people absolutely freak out. They tend to panic sell completely indiscriminately. And you know what the result of that is? Fundamentally solid, amazing businesses suddenly become a whole lot cheaper. It creates this crystal clear contrast between a sleepy, complacent market and a fearful, opportunity-rich one.
And that brings us to a really brilliant Buffett-style way of looking at all this. High VIX often appears when people are fearful, which can create opportunities for patient investors. This is the absolute ultimate takeaway here, guys. You have to completely reframe how you look at market fear. It is not this overwhelming, terrifying threat that you need to run away from. For the patient investor who actually understands what the VIX is telling them, a spike in the fear gauge is a giant flashing signal. It's a strategic buying opportunity just waiting to be uncovered.
So it all comes down to this ultimate question. The next time the market gets super turbulent, the next time that fear gauge completely spikes and hits those crazy crisis levels above 40, what is your reaction going to be? Knowing what you know now about exactly how this metric is calculated and what it actually represents, are you going to join the crowd and panic? Or are you going to be ready to stay patient, look right past the noise, and grab those hidden opportunities?